We have some exciting news. Earlier this week, YieldMax ETFs posted on Twitter teasing at something that they were announcing. A lot of people were thinking that they were going to come out with some weekly ETFs, switching a lot of the existing ones into a more frequent payout, but that's actually not the case. So what they've actually done is they are releasing what's known as Target 25 funds, and we can take a look at the SEC filing right here on this document, and we will be linking this down below if you want to check it out for yourself. But essentially, this is the SEC filing, and it is going to feature a bunch of Target 25 ETFs for AI, AMD, Amazon, Coinbase, Mara, MicroStrategy, NVIDIA, Palantir, Super Micro Computers, TSLY. So basically, they're top performing ETFs. They're going to convert some of these into a Target 25, which is essentially going to be 25% yield annualized or 2.2% monthly. So it's going to be a little bit more conservative than some of their existing ETFs. And the question is this going to get rid of the so-called NAV erosion? Because when you have extremely high yields, if we take a look at, say, TSLY, one of the first ETFs by YieldMax, it has a sky-high distribution rate of 123%. Now, as many of you know, this isn't very sustainable when you have such a high distribution rate. But in defense of YieldMax, they say that they're targeting the highest income possible, but there is going to be risk involved, which is the full downside and capped upside potential, which in essence, you're going to have some erosion because the fund really doesn't grow that much due to the covered call strategy. Now, if we take a look at the chart for TSLY, we can see it's down negative 79% from its all-time highs since inception. And this was released quite a while ago. It was released October 22, 2022. Pretty cool inception date. So it has been out for 3 years now, and it's eroded almost 80%. So that's pretty insane. A lot of people are not a huge fan of the share price decline in this case, because if you're not constantly reinvesting your distributions, you are going to fall a little bit behind. And we can actually see the total returns with TSLY. Year to date, it's actually positive 6.44%. And the overall return, if you had invested this in November 23, 2022, you're up 50%. So even though the share price of TSLY is down 79%, if you're constantly reinvesting all those distributions, you are going to be positive 49% total return. And that's something a lot of people don't understand with these ETFs. You have to reinvest it. And even if you're not reinvesting it, just calculating and adding up all those distributions you're receiving, it's going to be a little less painful than the share price alone, which is a thing that a lot of people get wrong with these ETFs. You're not losing 79%. You are going to be mitigating some of that loss with the distributions you're getting monthly. Because remember, this ETF has a very high distribution yield of over 100%. Now, you're not going to be making 100% year over year, but you're also not going to be losing 39% every single year, because some of these funds are very hard to calculate if you're not tracking them on a spreadsheet with the total distributions. Now, getting back to the SEC filing, we can see they've pretty much taken their top ETFs and converted them to these Target 25 ETFs. And as we mentioned earlier, it's going to be 25% annualized or 2.2% target month over month. So they're going to take a very conservative approach to some of these volatile ETFs that they have had. Because we mentioned earlier, TSLY has over 100% distribution rate. Now they're only going to be targeting 25. And in my opinion, this is really going to help conserve the NAV that a lot of people have been concerned about in the past few months. A lot of people just don't want to see all this red in their portfolio, and it kind of helps the minds of investors if they have a more stable NAV. And that's kind of what a lot of people have been asking about. They want the existing funds to have more stable NAV. And it seems from this tweet, they are listening, but they're not going to be modifying the existing funds. They're going to create new ones. So you have the option of going the more conservative route with possibly some more NAV stability, or go for the highest yield possible with their existing lineup of covered call ETFs. So you do have that option, and it's very good to see that they are offering that choice to investors like us. Now, personally, I think this is a very good move by YieldMax because a lot of investors really are concerned with that NAV stability. They want ETFs such as the ones by NEOs, which are leaning on the more conservative route of about 14% for QQQI. Now, by no means 14% is a conservative yield. It's definitely a very high dividend yield, but compared to other ETFs in the space that are utilizing option strategies to create income and paying it out monthly or even weekly, NEOs really is at the top of their game, focusing on stability. We can see this ETF QQQI is up 8.8% since all time, and that's just 1 year. So you're not getting that NAV erosion that YieldMax has been experiencing lately. And a lot of people are pouring their money into these ETFs because they're realizing they don't want to chase the highest yield possible. They want a balance between high monthly, or if they can, weekly income, and balancing that NAV stability, because you really also don't want to have a continuous decline in the share price for people who are looking to retire, because you can't reinvest those distributions back into the fund. A lot of these people who are retiring want to use those distributions as income to pay off bills or any other expenses, and they plan to use those as their income directly in place of their 9-to-5 job. That is the ultimate goal with these income ETFs. It's basically an income supplement or even replacement if you have a large enough portfolio. Now, looking back at the lineup, there are a lot of companies that I would be interested in, and I would like to see from YieldMax to have a fund of funds for this type of ETF. That's something that I definitely would be buying into. As you know, I am not a huge fan personally of a lot of single stock ETFs. I think there is way too much risk putting all of your eggs in one basket. Now, of course, diversifying is going to be a little bit harder because you have to buy all these individual companies one by one. So a fund of funds ETF that contains all of these target 25 ETFs would be ideal. And I know a lot of other ETF issuers like Roundhill coming out with their WPay ETF really are focusing on fund of funds because that's what people want. They want diversification and getting the best of both worlds, not having to pick and choose all these from the single stock ETFs list. Now we want to go over the fund summary for these ETFs, and they're all going to be the same, just different stock tickers. So in the case for AI, it's going to be the primary investment objective is to seek current income, and the second objective is to seek indirect exposure to the share price of C3AI, also known as AI. And they do know it's going to be generally subject to a limit on potential investment gains. Now, they're still going to be using a covered call strategy, but I think it's going to be a little bit more conservative, a little bit further out of the money, because if it's a little further out of the money, it means it can have some potential to grow, but in return, you're not going to have as much income. So they're only going to be targeting at 25%. Now, here's a thing that I'm not a huge fan of, and it's this total annual operating expenses, which is 1.67%. And in my opinion, that's kind of crazy. So the management fee is going to be 0.99%, which is not unusual. A lot of these ETFs do active options trading for us. So we do have to pay about a 1% expense ratio for the management fees. But these other expenses, now I'm not quite sure what these are going to be, but that's an additional 0.68%. And it's going to bring our total expense ratio to 1.67%, which is absolutely crazy, one of the highest in this space. And I'm not sure if they're going to be able to bring this down or not, we will have to keep a close eye. But if it is, that's kind of crazy in my opinion. But of course, if you're making 25% yield and the NAV is very stable, it can definitely offset that 1.67% expense fee. But we do have to keep in mind that bear market's not going to be ideal for this ETF, and these fees are definitely going to help compound the downside risk with these ETFs. So that is something you have to keep in mind. Now, going over to the principal investment strategies, it's going to be an actively managed ETF seeking to generate cash distributions based on a targeted annual cash distribution level of 25%. And I think 25% is a pretty reasonable level. It's not crazy high like 50%, but it's also not low like 10% or 4%. So it's pretty healthy in my opinion, especially since they're doing this on single stock ETFs and companies. You are going to have a little bit more volatility if it's a single stock company versus an index. And we also want to note that because it's a single stock, these are all single stock ETFs, you are going to have that synthetic long exposure. So they're not going to actually hold the underlying shares of the companies. It's going to be through what's known as a poor man's covered call. They're going to have a leap option and then selling calls against that in the short term to generate premiums. And if we head over to the actual option strategy section, they're going to generate income on a weekly basis with a target of 2.2%. And we can see they are going to be using a strategy known as a covered call spread, which is a type of selling credit spread. So I think they're going to be using spreads as well as regular covered calls to earn the premiums based on pretty much what the fund manager feels that week. And as most of these options incomes ETFs, taxes, we have to talk about taxes. Most of it is probably going to be return of capital, but we also going to see some ordinary income taxes as well. And as far as release date, I'm not too sure when it's going to be released. It says on this sheet that it's going to become effective immediately upon filing pursuant to paragraph B. Now, usually it takes 60 to 75 days, but it's very interesting to see that it was checked on the immediately effective date. So I'm assuming this is going to come out pretty soon, and it's going to give a lot of income investors a lot of different options because we have about 10 new monthly income ETFs coming out. I'm very excited for their Target 25 lineup. A lot of ETF issuers, especially the ones by Granite Shares on their Yield Boost lineup, which is targeting insane yields because they're using 200% leverage. I know their Coinbase ETF has about a 200% distribution rate. This is taking the opposite approach. It's taking something a little bit more conservative. I think they have been taking some notes from NEOs. They want to preserve the NAV a little bit. And I would love to see YieldMax come out with a fund of funds for these ETFs, or even use the target 25 or even a target 15 or target 20% on a index such as the NASDAQ or the S&P 500 to directly compete with QQQI and their most popular ETF, which is QQQI, $5 billion assets under management. But one thing that makes this ETF stick out is its low expense ratio of 0.68%, whereas the Target 25 ETFs are going to be, as mentioned earlier, it's going to be 1.67%. So it's more than double, absolutely insane. We will have to see what exactly is happening, but I think they are heading in the right direction with these Target 25 ETFs. They know the NAV decline is a huge problem, and it has been driving a lot of investors away because of that. So they're trying to get some people back through some little more conservative ETFs. It's going to help for retirees investing in these funds. Now, I definitely wouldn't recommend any single stock ETFs to retire on. There's just too much concentration risk on that one company. But if they do come out with some more of these ETFs and then create a fund of funds ETF, that could be a great option in the future. So I hope they come out with that and they take some notes from Roundhill ETFs with their WPay ETF. So let me know down in the comments what your thoughts are on these target 25 ETFs. Are they actually going to solve the NAV erosion? Are they going to be more stable? In my opinion, it probably will, because they're not targeting crazy high distribution rates. But let me know down in the comments what your thoughts are. Thanks for watching.